All right. My name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today's pointer is for my startup founders, any new ventures, but mainly I see this a lot in the tech startup space, an election called 83B election. And it's important for startup founders or even early employees. So if you are part of a startup, if you're not necessarily the founder, but you might be the first 10 employees of a startup. What tends to happen in that space is part of your compensation are stock units, specifically restricted stock units. So if you're working for the startup, they don't have much capital, but if you believe where the company is going, the company will pay you in shares down the line. So usually that happens in the form of vested shares. So they'll give you, say, 100,000 shares. The company may not be worth much at the time, but as time goes on, the shares grow, they become a lot more valuable. But it allows you to earn a lot of money on the back end as the company grows. And there's a vesting period. So you may get, say, 100,000 shares vesting, meaning that you'll have rights to actually get them over a period of time. They don't want to give you the shares right away and then you leave and you've only been with the company a year or two. So usually there's a period where you have to be with the company for a particular period of time before you actually get access to those shares or goal is hit. If we wind up going public or IPO, then you'll get your shares, assuming that you've been with us for a certain period of time. Now, the tax side of that is if you're with a company and it blows up, let's take a Facebook or a Google that have market cap of billions. So if you were one of the early employees and you had such an arrangement, your shares are quite valuable. From the tax perspective, every time that you receive your vested shares, it becomes taxable income. So you receive these shares on a delayed basis. As that company starts to grow, those shares become worth more and more. And with that, your tax liability becomes more and more. But there is a way to prevent this with the 83B election. The 83B election allows you to pay the taxes on the stock units that you were granted at the time you receive them, even before they vest. So going back to our example, if you were granted 100,000 shares that were to vest in 3 or 5 years, with the 83B election, you can elect to pay the taxes today, not 3 years or 5 years. And you are paying taxes on the value at that day and not 5 years. As you see, it can save you a significant amount of money on the back end. If you believe in the company and you assume that the company is going to blow up, those shares are going to be worth a lot less today than what they are tomorrow. This election allows you to pay taxes on the value today versus what it's going to be 5 years. So it is quite the money saver. There are a couple of things that you need to do. One, this only applies to restricted stock units. Now, it's not to get completed with stock options. With stock options, employees get paid in that manner today. Let's just use Google as an example. With most folks at this point, they're given stock options, not stock units, where the difference is with the options allow you to buy the shares at a certain price. Usually it's a discounted price, so you're able to make some money versus with stock units, you're actually given the shares regardless of the price. There is no option to purchase at a certain price. You're just given. There's the difference. This election only applies to stock units, not stock options. So I have a lot of clients that have options. So this play would not be available to them. Now, with these stock units, what you need to do with the election, not a form that you file to make this selection. It's actually a letter that you send in to the IRS at the time that you're granted the units. Within 30 days of getting the units, you have to send in this letter. It's letting the IRS know that you're making the election. And then that way, when you actually do get the shares, you pay taxes on the value of those shares. But if you get those shares and then sell them, you do have to pay capital gains taxes on the difference between what you sell them at and the value of the shares at the time you made the election. So if you sell the shares, you can have some pretty significant capital gains taxes, but the capital gains rate is a lot lower than your ordinary income rate. On the federal side, at max, you're going to pay a 20% tax rate versus if you receive the shares and you had to pay full freight without that 83B election, assuming you're at the top bracket, you're looking at roughly 37%. It can offer significant savings. If you're in a startup situation and you're offered shares as compensation, you definitely want to make sure that you are utilizing that strategy. You can save a ton of taxes on the back end. Now, that is also assuming that the company grows and the value of those shares grow. You are taking a bet that the value of those shares are going to go up. They can work in the reverse too. If it doesn't work out and the value of the shares go down from when they were granted to you, then you actually will lose because you would have paid the taxes when the value were higher and there's no way to get that money back, nor do you get a credit for it. So it is a bit of a gamble. Those shares could go down, but that's why this strategy is really appropriate for more so startup, because at the very beginning, the shares just don't work that much. The bet that you're placing that it is going to go up is very small when you're in the startup world versus companies that are more established. So that's all for now. I hope this was helpful. So if you have any more questions about this topic or any other accounting or tax related questions, feel free to reach out. I'm happy to help. I'll talk to you in the next one.